You are sitting at your computer looking at a personal loan offer. The monthly repayment perfectly fits your budget. If you click Accept right now without checking two specific hidden clauses, you are about to voluntarily walk into a legally binding financial trap. Most borrowers look purely at the monthly payment. Lenders know this. They engineer the math so the monthly payment looks incredibly safe, while the actual structure of the debt quietly drains your bank account for years. Let us look at the first invisible mechanism holding this trap together: the origination fee. Suppose you apply for a $20,000 personal loan in the United States to execute a debt consolidation strategy. Your credit score is decent, and you get immediate loan approval. But when the funds actually hit your checking account, the deposit is only $18,400. What happened? The lender legally deducted an 8% origination fee right off the top. They kept $1,600 just to process the digital paperwork. But here's the brutal mathematical reality that nobody warns you about. Your principal balance is still exactly $20,000. You're paying daily compounding interest on thousands of dollars you never even received.
This silent extraction is not just an American mechanism. If you look at the UK financial system, lenders constantly use front-loaded administrative costs to disguise the true cost of borrowing money. In Canada, banks use identical tactics labeled as establishment fees to bypass their heavily advertised artificially low interest rates. The bank's entire goal is to extract their profit on day one. But the second mistake is much worse. Most people are already planning to do it, thinking they are outsmarting the banking system. You tell yourself you will take a 5-year loan, but aggressively pay it off in 2 years to save money on interest. That is where you hit the legal wall known as pre-computed interest. Most people assume loans use simple interest, where you only pay for the exact time you hold the money. But many high-profit lenders use pre-computed interest. This means the bank calculates their total 5-year profit the exact second you sign the contract, and they permanently bake it into your balance. If you work overtime, sacrifice your weekends, and pay the entire debt off 3 years early, it does absolutely nothing. You do not save a single dollar in interest. Your highly responsible financial behavior is mathematically penalized.
Before you ever sign a digital loan agreement, you must ignore the monthly payment and focus entirely on the APR, the annual percentage rate. The APR is the single legal metric that forces lenders to expose their hidden front-end fees. If a bank offers you an 8% interest rate, but the APR is suddenly 14%, they are hiding heavy origination fees in the fine print. Your mandatory checklist is incredibly simple. You must demand a simple interest loan. You must verify there is a flat 0% origination fee. And you must see in writing that there is absolutely no prepayment penalty. If the lender refuses, close the tab and walk away immediately. If this breakdown stopped you from signing a deeply toxic contract today, hit subscribe, drop a quick like on the video, and send it to someone about to take on new debt. Thank you for giving me your focus. If you need to know how to strategically wipe out your credit card balances without destroying your credit score, tap the related video on your screen right now.